familiar faces. Already a warm welcome to the home of the London Stock Exchange. Our association and sponsorship of the New Entrepreneurs Foundation is something very important to us. Not just because of the New Entrepreneurs Foundation and who they are and what they do, but this is actually part of our core mission, which is, as an infrastructure company, to help direct capital in an efficient way and help put it in the hands of those who will create value out of it, who will create jobs. And the UK is uniquely well positioned, not just in Europe, but globally, to leverage the tremendous academic potential that is coming out of UK-based universities. And it is no surprise and no accident that out of the pool of 23 million small and mid-sized enterprises that populate the European Union, almost 5 million, 4.8 million actually, are based right here at home in the UK. There's an incredible performance today already compared to our European neighbors, and frankly, relative to the size of the economy and the population, an achievement that compares with any other country in the world, including the United States, in terms of taking bright new ideas, they may be science-based, they may be service-based, they may be anything else, and converting them into entrepreneurial opportunities. So it's not just the capacity to innovate, to come up with new science, new ideas, but it's the risk-loving attitude of those who come up with these ideas, the fact that they're willing and able to take the risk to convert it into enterprises that will have a profound impact on our societies. These companies operate up and down the country. There's quite a few here in London, but London is by no means the most important concentration of them. There are clusters everywhere in the country: Glasgow, Edinburgh, Manchester, Birmingham, of course, Cambridge, Oxford, Durham University, and many other locations. And what we do here at the London Stock Exchange Group, and I know I've forgotten many, I see some of you smiling, you didn't mention one. I apologize in advance. But what we do here at the London Stock Exchange Group is not only provide the means for these companies to raise long-term capital, be it debt or long-term risk capital, but also think and try to think ourselves, try in fact to emulate all of you. What can we do to innovate, to make entrepreneurs' life easier? And a lot of that is working, of course, with regulatory and government authorities to try to sometimes remove the shackles of very old legislation or regulation, but also address very important issues. For example, the recalibration of our fiscal system in favor of risk capital, when it has historically favored debt, particularly wholesale debt for deductibility. And that's a lot of work with many constituency stakeholders from government, treasury, coalition at the moment, but also Parliament, both the House of Lords and the House of Commons, to articulate the benefits to each constituency, to articulate the benefits to the UK of what you do in terms of creating ultimately good jobs, good paying jobs that are not delocalized, that give opportunities for young generations of graduates and for other citizens to work near their homes, again, up and down the country, in new areas of technology, new areas of business and service development. That is our core mission. We do many other things, from risk management to indices. We're global today. In fact, distribute our products in over 90 countries around the world. But what we care about the most is right here at home, what is it that we can do? And so a lot of the innovations that we ourselves have sought to promote, creating, for example, a long-term debt market to permit small and mid-sized enterprise to raise small amounts of long-term debt, 10 years and plus, at a very, very cheap cost, very, very efficient fashion. Continuing to promote equity raising, risk capital raising venues. AIM is well known, but there's been a lot of other innovations. The high growth segment, for example. There, in fact, will be very soon, in a few weeks, another innovation introduced by the London Stock Exchange, a new initiative called Elite, to enable entrepreneurs, just like you, many years before they even think of listing in markets, of IPOing their companies, or doing some other form of public capital raising, to already start thinking of the next step in terms of private financing, helping introduce them to investors that are not investors in publicly listed companies, working with academia, working with universities, like Imperial College, for example, business school and others, to help these companies refine their business plan, refine their governance, and prepare them for long-term funding. So we're also interested in working with companies even before they even get to the point of considering a listing, which of course is not something we do for our shareholders, but to help promote the ecosystem. And I'm prepared to say, and in fact we've said it publicly, my colleagues and I, that in the last 18 months we've seen nothing short but a technology revolution right here in the UK. The pace of innovation, new initiatives that the business sector as well as government authorities have taken in favors of entrepreneurs. And in fact, in the last 18 months or so, the rate of new IPOs, we do an IPO every day, almost every day at the moment. The vast majority of them, in fact, very small companies. The smallest IPO we've done in the last 12 months was £1 million. So very well suited to the need of very small companies. But most of them, high-tech companies, great performance, by the way, institutions are completely rediscovering right here at home the opportunities of technology, tech investing, high-growth investment. Investors ask me all the time, wherever I travel around the world, where should we put our money? OTC products, commodities, emerging markets. And for 2 years now, we've been saying right here at home. Look at the WANDiscos of the world, the Monetize, the Applied Graphene Materials, and many, many others. These stocks are up 100, 200, 3, 4, 500% in very, very short order. As soon as, in fact, they've hit the public trail, made themselves known to investors, they've often been revelations. And then to those who say, yes, that's true, but the US leads in terms of appreciation for technology, ability to value these companies, I said that is certainly the perception. If you read some of the more old-fashioned section of the British press. But the reality is a bit different. The biggest company we've got on the AIM markets, a company called ASOS, it's worth almost £6 billion. It's not as big as Amazon, but it certainly has been as successful in terms of its performance track record, investment track record, actually trades at a higher multiple than Amazon themselves. So you do find that homegrown UK companies listed here, actually, if they deliver a track record of growth, have nothing to be shy or nothing to be ashamed of in terms of the multiples they achieve right here at home, the valuation, versus the United States market, which, by the way, is a lot less friendly to non-American companies listed in their growth market than it is in terms of multiple to American companies. But if you were to compare, for example, the multiple on the NASDAQ composite with that of the FTSE Technology Index, you'll see actually FTSE trades at a high multiple. In fact, has enjoyed a better performance in the last 18 months than its NASDAQ composite competitor. And where does that come from? Well, simply a complete reassessment by investors of the potential that you offer as entrepreneurs, as innovators. There are 870 UK companies today listed on our markets valued at well over £50 billion, procuring more than 250,000 jobs on our junior market, which are high-growth tech companies. And so how do we go from there to the next stage, which is retaining right here at home these companies and helping them grow from what I like to describe as startup to startup, so that the Twitters and the Facebooks and the Microsofts of the world, that a few of them at least, can be right here in the UK. And this is where we still have a deficit. In fact, a recent, I think, statistic which was published by the Economist, if my memory is correct, in December, when you look at the most successful recent companies operating in technology and high tech, if you look at the most successful startups of the last 25 years, which, by the way, are very, very large companies today, of the 100 most successful, largest companies today that started in the last 25 years, only one is European-based. 16 are California-based. And that's where we're missing out. We're not missing out in your segment, in startups, in innovation. We've got the technology, we've got the universities, we've got, by the way, plenty of capital. Whether we direct it efficiently to young companies and young startups, when historically the financing of innovation and startups has relied on bank lending and bank debt, which is fundamentally technically not the right financial instruments to finance startups, where we can talk about this at greater length. But we've done very, very well. Where we have not always well served those innovators and entrepreneurs, is to underpin their innovation and their ambition by saying, yes, you're starting like ASOS when you first listed. You were worth 17 million pounds, you're worth 6 billion today. But maybe one day you could be a 60 billion pound company. Is ensuring that entrepreneurs have the ambition to carry that growth to the next stages of their growth, so that the symbols of technology success, and it may take another 5, 10, 15 years from now, no longer be just referred to as American successes. We should have some of these very, very large, globally successful companies listed right here. What it is effectively, as I said, from startup to startup, is an escalator. It's having the full, if you want, a suite of financial products as the company grows, to ensure the entrepreneurs have to worry less about the next round of financing, so they can be worrying more about product introduction and marketing and business development. And that's another thing that we do. The way a diversified funding landscape can help unlock that growth potential, again, for UK business, works in several ways. I mentioned earlier the traditional dependency reliance on bank lending. That's still a fact today. 70% of corporate financing in the European Union, see that includes the UK, at least for the time being, 70% of corporate financing is supported by bank lending. But it's easy to understand if you're an entrepreneur that if you seek to raise financing through a traditional bank loan, the first question, given the inherent economic risk of a young company, of a startup, the first question is what guarantee, what assets can you offer as a, if you want, guarantee for that loan. That is not what you want to hear as an entrepreneur. As an entrepreneur, what you need is a form of long-term capital that does not require you to pay interest every month, from month one, that gives you enough time to develop your business, and when you don't need to, for example, if you are a successful academic looking to set up your business, you don't need to mortgage your house or ask friends to provide assets or family so as to provide a lien or a mortgage so as to guarantee the bank loan. And by the way, this is not a good product for the bank either. Given the economic risk, and by the way today, the accounting and regulatory tightening of the regime in terms of balance sheet and regulatory capital affected to SME lending and particularly startup lending, the bank is not going to get a good return for the risk. By definition, a fixed income or an interest or loan is capped in terms of return, or it's benchmarked on some underlying monetary benchmark, LIBOR or others. And so that does not account for the risk of the company potentially going belly up, which is reasonably high in the early years. So the bank is not happy with the returns that you get, and certainly the entrepreneurs is not happy with the lien, the mortgage, or the interest payment that start with. Of course, you'll understand that the right kind of financing is the financing where the interest of the investor and that of the entrepreneurs are fully aligned, where the investor accepts the possibility ultimately of business failure, but in exchange is asking for potentially unlimited upside. That's the definition, of course, of equity investment. Yet in our fiscal system, the taxation of equities at the corporate level, at the dividend level, at the capital gains level, and at the financial tax, transaction tax level, which we call stamp duty in the UK, at least for blue chips. It's being repealed in April for AM and junior stocks, which is going to be a big, big boost for that segment. But if you look at that quadruple taxation on the one hand, versus in the financial sector, particularly for banks, deductibility of interest, it's clear that there's an imbalance in terms of the fiscal treatment of investments. And so the recalibration of that fiscal regime is very important to promote cheaper access to long-term risk capital, because that is what underpins entrepreneurs such as yourselves who are seeking to create value whilst they're taking risks. And it's that recalibration together with regulatory initiatives in the space to facilitate access to smaller chunks of listed or private equity with less of a regulatory burden, as we've seen in the past. That is starting to have a deep impact. If you look at the pace, the quality of IPOs in the AIM market linked to innovation, recent startups, technology is just remarkable what's happening. So we need to do more. We will continue to work with the government. I do expect that this government and others behind it will continue to innovate. We expect a lot of any budget statement, so let's hope that there will be more good news for startups and for new enterprise. But there is also a set of international regulations that we spend a lot of time seeking to influence. Solvency II, Basel III, accounting regulations, IFRS in particular, that do put a natural disadvantage or handicap in the face of equity investments, forcing a lot of long-term buyers of equities, insurance companies, for example, that manage very, very long-term liabilities and effectively through Solvency II have been banned from equity markets. The vast majority of the large European insurance companies, be they European only or global in their operations, have reduced their allocation to equities in their portfolios from 50, 60, 70% plus to less than 5% on average. Here's a long-term source of equity capital that we need to work on. Pension funds in the period 2008 to 2012 in the UK have also aggressively reduced on the back of not only performance, risk aversion issues, but also accounting rules and the potential inclusion of pension funds within the scope of Solvency II. Substantially reduced in the UK, gone from about 70 to 35% allocation to equities and an asset class. Effectively, what we're telling governments, what we're telling the authorities in Brussels as well as here and overseas, is if you force investors that need to make a long-term risk capital investment out of equities, you are forcing them to short the real economy, which in the long run is really the only way. I mean, you can seek to invest in commodities, in all sorts of exotic instruments, but ultimately it's all underpinned by that smallest of asset classes, 6% of global financial assets called equities. And forcing long-term investors to short the real economy, by definition, will penalize savers, will penalize all those who need to basically underpin the returns on what you do, on that innovation. So I want, in conclusion, there's many other statistics that I could mention, things that have been done in the last few months, but I want to not only encourage you, but commend you for what you do. Because it does take courage. Setting up a business, taking on the risk, financial risk, reputational risk, business risk, family risk, stress in your own life, in terms of your family, your friend relationship, to commit so much to the creation of a business needs to be encouraged and commended. And we should make success for people, young people out of universities or who start out on their own. We should make success, or the ability or the willingness to create an enterprise, one of the prime avenues for careers. And that, I think, is also changing. I remember when I graduated, the notion that you could be, from my university, the notion that you could be an entrepreneur was shared by an excruciatingly small percentage of graduates. Certainly, I did not belong to that happy few. Today, it's changing. Today, everywhere I go, when I visit universities up and down the country, I hear young students, or when I meet with young entrepreneurs who have recently left university or other avenues of learning, I hear that they've almost singly considered being an entrepreneur as their way forward. That, I think, is also going to change the nature of our economies and the distribution, if you want, of capital from the top, i.e. a central bank helping a small number of big wholesale banks to leverage their balance sheet to lend to business. It's effectively centralization of capital distribution decision is going to change. I think capital more and more is going to be distributed from the bottom. Crowdfunding is one emanation. Crowdfunding is going to have many challenges. Regulation is going to be one of them. We'll see scandal affecting crowdfunding, great successes but also failures. But the ability for the financial economy to restructure itself so as to be able to distribute small amounts of capital, we're not talking about billions, quantitative, easy type scale. Young businesses don't require this sort of, perhaps with some exceptions, like biotech, for example, capital-intensive businesses. But the ability for us, financial professionals, together with government and regulators, to restructure the distribution of capital, to distribute capital at the bottom, if you want, of the triangle of financial power, in small chunks, appropriately priced, and more importantly even, the right type of capital to support risk-taking. Not only is going to power the technology revolution that's happening in the UK, but it also helps, I believe, bridge a deeper societal gap, which is the 1%, 99% bit. If you distribute capital from the top, it's likely to stay more on the top than gets distributed by the time it gets to the bottom of the ladder. If you do it in reverse, if you find ways to make the right type of capital available to young entrepreneurs and older entrepreneurs, there's no age discrimination slant, I hope, in my comments. If you make that capital available at the bottom of the pile, then you distribute capital in a much more diversified fashion. And potentially you make, perhaps not capitalism, I don't want to go as far as that, but certainly you make business popular again. Because there is a gap today between citizens and their appreciation of what a capital markets-driven economy does for them and opportunities it presents to their children, and the way business assesses itself. And ensure that we can bridge that gap, that societal gap in perception, so that families, perhaps older folks such as me, see their kids working locally, getting a good paying job, because an entrepreneur has found it actually easier to raise capital and create that new biotech business and that new service business and that new social media business, hence offering good jobs for everybody else, looking for good jobs right here. And you can bridging that gap, making effectively capitalism socially useful, i.e. popular capitalism. The way we believe to make it popular is actually to ensure it is popular in its distribution. And this is what, as an infrastructure company, we want to do. We certainly want to add to the debate. And again, in conclusion, I would like to both commend you and encourage you to persevere. Being here shows that you've already gone some ways towards being successful, and working with the foundation shows that you're certainly working with the right people and you've got the right attitude. But there are many challenges ahead in terms of actually getting started, going to the next stage of capital raising, matching your own personal ambition with a competitive environment, which is real. Where is your ambition going to take you? Where are you going to be satisfied? Because satisfaction and a decline of ambition, of course, filters through the entire organization and can impact the success of your organization in an environment where many of your competitors are also going to be very, very ambitious. Perhaps you're right here at home, elsewhere in Europe or in the United States. And what we want to do is create the science and the capabilities through capital raising that the only limit to that ambition, and it shouldn't be the ability to raise finance. It should be your own assessment as to when you believe you will have made it or will have achieved your goals. So many congratulations again, and we and my colleague and I here at the London Stock Exchange, I can assure you, are intensely dedicated to do what we can to make the financial aspects of your entrepreneurial ambitions and enterprise easier going forward. Thank you very much for being here. I think there's a fantastic panel. There's going to be an opportunity for you to ask a lot of questions and engage with our excellent panelists. I want to thank you for being here, and once again, welcome to the home of the London Stock Exchange. Thank you.